Hello everyone, welcome to Think Wealth TV. Today we're going to be talking about over-diversification. Is it a myth or is it the truth? If you noticed on the thumbnail of this video, it's blue. That's for educational. The green ones are keeping track with the portfolio, updates, dividends, premiums received, detailed portfolio looks, things of that such. This video is going to be very detailed. That's the way we do on this channel. So you don't have to watch multiple videos to get the information you need to get all in one place. If you like this content, please like and subscribe. It helps us out the most. And hit the notification bell, that'd be awesome. Okay, so we're moving on into the main subject. Some people say you should own 3 to 8 stocks. Some say 1 in each sector. Personally, in my opinion, what I've noticed is it seems like if you own over 50 stocks, people start saying, I think you're over diversified. Now, something to consider is most fund managers and most investors can't beat the S&P 500, and yet they have under 500 stocks. So if you're over diversified and that's more of a defensive play and doesn't work that well, that you need to own less stocks, how come they can't beat the S&P 500 when clearly they own less than 500 stocks? There is one fund manager that managed to beat the S&P 500. You might know him. His name is Peter Lynch. He's a famous, if not the most famous, hedge funds manager. If you remember earlier, I said most hedge fund managers don't beat the S&P 500. Well, he did. For 13 years, his average return was 29% annually. It over double performed the S&P 500. The reason I bring this up is since we're talking about over diversification is this section right here. As you can see, it says Lynch bucked many prevailing trends on mutual fund investing, such as buying many more stocks than usual. Magellan had about 60 stocks when Lynch took over. He was advised to trim the numbers to 25 to 30. That's what a lot of people are saying right now. I've heard 25 to 30, 25 to 35. Usually they say over 12, but the same thing's happening right here. But instead, he bought hundreds of stocks he believed were bargains, including the then unusual step of owning multiple stocks from the same industry. In 1989, Magellan held an unheard of 1,400 stocks. And mind you, on average, he was returning 29%. That's insane. I'm pretty sure most people would say it was over-diversified, but it seemed to play off pretty well as an offensive play. Okay, so diversification, they say, is that pure defensive play. Kind of like ETFs, right? If you invest in ETFs, you have that pure defense. Well, when you invest in ETFs, they are over-diversified in a sense, correct? Because they have at least 50 stocks generally. Some have 500, some have 3,000. They have quite a bit of different holdings inside of them. ETFs, there's both winners and losers. I try to invest in a lot of winners, but I do knowingly invest in some losers, meaning some turnaround stocks and some cyclical stocks. Now, I do believe that diversification is extremely important to shield your assets and to protect your portfolio from market volatility. But I also believe that it can, in some instances, be an offensive play as well. The first thing you need to ask yourself, though, is if you're either an active investor or a passive investor. If you are a passive investor, you might not have the time, or you might not want to keep up on all of the earnings, financials, business progression, and news of the various companies that you own. That's a lot of research. In that case, being a passive investor, ETFs are going to be your best friend. I would own very few ETFs. That would be most beneficial. Owning multiple ETFs becomes something that takes a lot of your attention. The reason being is sector overlap or individual stock overlap, meaning whatever you wanted your allocation to be in either sectors or stocks, by having multiple ETFs, you're creating overlap, which is now creating over diversification in certain sectors or individual stocks. Let's pull up an example of how sector overlap can cause an issue and can cause over diversification when you own multiple ETFs. Let's say you own VOO, the S&P 500 index you believe in, the too big to fail,
And you don't look at the allocations first of all. And second, you want to have some more exposure to technology. Well, you know the S&P invests in multiple different industries, the 500 biggest companies, right? But you want more exposure to technology. You're thinking maybe 15, maybe 20% max, because right now, in the 2020 crash we got going on, technology is doing really well. So you're thinking, why not have a little bit more exposure to technology? So you pick up an ETF called VGT. It's a Vanguard Information Technology. And you see, wow, you know what? This has 87.56% exposure to technology. That looks great. I'll own 10% of VGT and I'll own 90% of VU. Let's say you want 100% equity exposure. Well, if you don't look at the holdings, which I believe a lot of new investors don't look at how different ETFs are weighed, but as you look at the VU by itself, you have 24.08% exposure to technology. So just by owning the VU, you already have 24% exposure. So more than likely, you do not need VGT. But on the flip side, if 24.08% exposure wasn't enough, you wanted more technology, then yes, VGT would be great. And in that case, you wouldn't be over diversified. If you think that 24% is not enough, and you personally want more, then diversifying in VGT will get you more technology exposure. When you're looking at different ETFs, just take note of the overlap. Even if you look at the holdings, we have the Vanguard Technology ETF on the left, the S&P 500 ETF VU by Vanguard on the right. If you look at their holdings, you have both holdings for the number one are Apple. So their biggest holding in both ETFs are Apple. The second biggest holding in each ETF is Microsoft. Now, as we go down, they change a little, but overall, the main two holdings are the same. For the Vanguard, the third holding is Visa, and it's the 10th holding for the S&P 500. But there's a lot of similarities, so that's something you need to take in consideration. And on the flip side, again, if you did want to own more Apple and Microsoft, and you wanted Visa, MasterCard exposure, you wanted more of that, then technology would be good. You want to look at the allocations when you're investing in ETFs. Same goes for the holdings. There's nothing wrong with owning multiple ETFs as long as there's not too much overlap. And that really depends on you. Like I said, if you want more overlap, just be aware of when you're investing in ETFs and get those ETFs that have the overlap. If you don't want that much overlap, you don't want so much allocation in one sector, you might not want to buy a certain ETF. You might have to look for different ones. So just be aware of those situations.
A simple way a passive investor could get diversification without having over diversification, and remember this is just an example, is by investing 70% of their portfolio in VOO, that's a Vanguard S&P 500 index fund, and they can invest 10% in VXUS, that's a Vanguard international fund with no US exposure. They can invest 10% in VNQ, Vanguard real estate fund, and 10% in BND, that's a total bond market fund. Now, I'm not sponsored by Vanguard, but I feel like I should be. But if you guys would like something better, like a free stock from Robinhood, if you haven't signed up for Robinhood, there's a link in the description below for a free stock.
All right, guys, there's something important I wanted to bring up regarding over diversification. And we just talked about VXUS, so I thought it'd be a perfect time to bring it up. Let's say you have a friend who's an investor, knows about the stock market, knows about investing, and you approached the person, the individual, and you said, hey, I'm thinking about investing in international stocks. I have a lot of domestic holdings, almost all my portfolios in US stocks. They'd say, well, that's a good idea. And then you tell them, hey, so I've been doing all this research and I've been looking at so many different stocks, so many different countries I've been looking into. I've been doing hours and hours and hours of research, and I ended up buying 7,000 different companies. They'd probably think you were crazy. Even more, they would think you're really over diversified with 7,000 different stocks. But if you told that same individual, hey, I actually invested in VXUS, I put 10% of my money in there, you say, oh, that's a great idea. Now you have 10% international exposure. So 7,000 stocks would be crazy. But if you buy this one ETF, you have 7,395 different holdings. So investing in this one ETF, you're essentially investing in 7,395. The reason I bring this up is that there's quite a few people that say, oh, you shouldn't own these many stocks, you shouldn't own this, you shouldn't own that, and they own ETFs. I've heard people say, I have close to 50 stocks, I'm probably over diversified, I probably need to cut back. If you can't manage the stocks, that's one thing. But if you think it's that a certain number, 50, makes you over diversified, you shouldn't be holding any ETFs, because then you're over diversified on every single ETF you own for the most part. Now, VXUS is a little extreme. I'm sure there's ETFs that hold even more companies, but even VTI, that's a very popular one, that has over 3,000 different holdings. VU, what we've been talking about in this video, we mentioned earlier, that has over 500 companies. So over diversified really depends on you.
Let's say you're an active investor and you have the time and you also don't mind researching various companies. If that's the case, you need to then ask yourself, how many stocks can I manage? If you have too many stocks and you can't manage them adequately, then you're probably over diversified. Now remember, you can own both ETFs and individual stocks. One example could be maybe you have 50% of your money in ETFs and 50% in individual stocks. If you can only manage 2 or 3 stocks, very little, that's all you have time to dig deep into, then maybe you want to have 90% or more of your portfolio in ETFs. Me personally, I like to have about 3 stocks in each sector, up to a max of 5. The only exception is REITs. Since REITs are quite a bit smaller, I'd like to have between 5 and 10 of those. Now this just works for me and my personal situation. Does not work for probably everybody. Back to the question, is over diversification a real thing? Well, when it comes to ETFs, not in my opinion. They have so many different holdings, they're so big, I don't think they're over diversified, or they can be in that sense, unless there's overlap by owning multiple ETFs. Now, when it comes to owning individual stocks, as long as you can manage them, you can have as many stocks as you want, and you won't be over diversified. If there are too many stocks to manage, then that can become a problem and lead to over diversification. If that's the case, you might want to consider decreasing the amount of holdings you have or investing in ETFs. I hope this video provided a little bit of clarification on over diversification, and if it did, even just a little bit, make sure you click that like button, subscribe button, and notification bell. Thanks.